Good evening. I'm Michael Garrett, and I'm the Institute's Associate Director for Development and Public Affairs. I'd like to welcome you here for a talk sponsored by the Einstein Legacy Society. Much of what we do in the Development Office is known as stewardship, that is, taking care of the resources with which we've been entrusted, and in doing so, honoring the donors and those who've come before us who've built up or helped to build up all that we have today. We feel that this talk tonight is a form of stewardship, enabling all of us to learn how to manage our own assets for retirement during these uncertain times in the financial markets and the economy. This is not completely selfless on our part. The Einstein Legacy Society is a way for us to recognize those who have advised us of a bequest or otherwise included the Institute in their estate plans, and we hope that you will all consider becoming members as you plan for your financial future. We are most grateful to Roger Ferguson, the President and CEO of TIAA-CREF, who suggested Brett Hammond, Managing Director and Chief Investment Strategist for TIAA-CREF, as our speaker tonight. Dr. Hammond, who will speak on the subject, Dreams Deferred, Rebuilding Your Retirement Strategy, serves as TIAA-CREF's ambassador on issues relating to the macroeconomy, financial markets, and long-term investing, working to advise TIAA-CREF clients across the country in person and through regular video and audio podcasts and articles. He's also responsible for asset allocation modeling and institutional advising, economic and market commentary, and investment product and portfolio research. His research focuses on asset allocation, and it's been integral to the development of TIAA-CREF's life cycle funds, asset allocation, and advice services. Dr. Hammond's a member of the Forbes.com Intelligent Investing Channel's All-Star Investor Panel, and he's been quoted by many business and local media outlets on topics related to long-term investing, including the New York Times, Washington Post, Associated Press, and CNN Money. He's also appeared on CNBC and on Bloomberg Television. Prior to joining TIAA-CREF, Brett held positions at the National Academy of Sciences, UCLA, and UC Berkeley. He received a PhD from MIT and BA degrees in economics and political science from the University of California at Santa Cruz. Please join me in welcoming Dr. Brett Hammond.
Well, I think I don't need to stand there at the mic. I'll have to wander over and push buttons. But thank you very much. This is a big thrill for me. Thank you to the Human Resources Office and all of you for having me come today. I'm a university brat and grew up in a think tank atmosphere. In my case, the Rand Corporation. And so for me, coming to a place like this, albeit with a very different mission, it's a big thrill. So thank you for having me. I'm hoping to find in Washington, once a metaphor takes hold, they beat it to death. But we'll hope to find some green shoots in some of what I have to say tonight. But I don't want to overdo it, because one of the things that happens is we regularly have people from Wall Street come to us. We're what's called buy side, and Wall Street is what's called sell side. And the sell side folks come to us, and they're always talking about, oh, it's always getting better. It's the light at the end of the tunnel is not the oncoming train. It's getting better. And so I don't want to overdo it, but we'll try and find some good news. So let's jump into this. I have far too much material, so some of this will rush through a bit. But I'll make sure to hit on the important points. This is just the introduction. This is just to give you just to remind you of the measure of output of goods and services in the United States on an annual basis since 1930. And you get it, right? You see the Great Depression over on the left with lots of dark down bars, and you see a couple over on the right, or one on the right, and that's a forecast for this year that we've made that the economy is going to drop about 3%, more or less depending on the success of the stimulus package and other things. That doesn't seem like much compared to what the bars you see on the left, but it's the worst since 1946, if that turns out to be true. And 1946 was a transition time between a military economy and getting to a civilian economy. So it was, people thought they were going right back into the Great Depression, but fortunately it was transition issues more than anything else. The last worst one was in 1982, down 2%. And then of course you see little bumps for 73, 74. It was very painful in the markets, but somewhat less painful if you just look at pure GDP numbers. We also had very high inflation in the late 70s, early 80s. So just to give you a sense, this also, we can give you a little sense. In the current recession, how does that compare to the Great Depression? I get that question everywhere I go, at colleges and universities. And you can see we're nowhere near the Great Depression. And what we're looking at is peak to trough. And we get, 55% down in the stock market is horrible, but it didn't quite make it. And in the Great Depression, it was 83% down, and then 50% up, and another 40% down, and so you had ups and downs. But this is still a severe recession. So, quick summary of what I want to cover today. I want to talk about housing, because I think it's housing that's at the center of the problem, and we all know that. I'm just going to, by this time, you've probably read enough analyses of how we got into this mess, so I'm going to cover that relatively quickly. Talk about the collapse, what happened to the collapse that leaks into the financial sector, and then the two sectors bring the economy down. What emergency medicine is being applied to this problem at the moment to address economy, housing, finance, and the budget, and noting that it's all intertwined. What about long-term health care for the economy and the financial markets? And this is pretty dicey. And then finally, what can an investor do in light of all this? So foundations for a vicious cycle. Well, I think there's four big ones. And what I think is interesting here is to step back and because we all know that housing did something, right? It wrecked the economy, or in combination with some financial issues, they wrecked the economy. But what's behind it all? And so rather quickly, I'm just going to give you the highlights. There's four basic factors. One is the evolution of the financial system. Well, what does that mean? Well, I think there's two factors here, two sub-factors. The growth of a herd of mega elephants. Citibank, HSBC, Bank of America, Deutsche Bank, and there's others. Many of you, like me in this room, will remember the good, well, I don't know if they were good, the old days when I grew up in California. The Bank of America seemed huge. In fact, kids a couple years older than I am, thought it was so huge and ugly and evil, they burned it down in Isla Vista in 1969. But it was a peanuts compared to what it is now, because it couldn't operate across state lines. It couldn't be an investment bank, a brokerage, an insurance company, and it's all of those things and more now. I can stick my card in and get money right next to the Forbidden City in Beijing, to say the least. So you get this evolution, and along with that evolution of the institutional structure comes an evolution of also financial instruments, mainly derivatives, but in asset-backed securities, which didn't exist before. So, and then you say, well, so what? Big, monstrous changes in the financial system, but a stagnant oversight system. You still have the SEC and the Office of the Control of the Currency and all the things that take care of the financial system. And they're pretty much the same as they were 20 years ago. They're supposed to take care of the leg, or another one has the tusk, the tail. But nobody's thinking about the whole elephant or the system. And there are a lot of barriers to that, because with all the international financial flows, it's very hard to create an international oversight system. Global savings imbalance. You people are just wonderful, because Americans have now begun to save, I can report. About 3 to 4% of your income on an annual rate over the last several months. Average Chinese household saves 40% of its income. And most of the rest of the world is in between those two numbers. But what it means is that over the last 20 years, there's been a huge pile of savings that's looking for places to invest. And that's been a critical factor in all of this. Low short-term interest rates, well, we have them now, but we also had them at the beginning of this decade, and we'll see how that plays out. The Fed was responding to an economic downturn and the dot-com bubble bursting, lowering interest rates. Excessive leverage. Everybody borrows. Everybody's had a great time borrowing. Everybody being you, me, the banks, anybody we can think of. All right. So again, you know all this. You're going to know all this, but let me just do this quickly. The mortgage cycle. This is the basic thing that helped bring us all down, as you all know. But I'll just remind us what happened here. Home buyers. Well, my original house loan when I first bought a house was great. I went to the NASA Federal Credit Union that took care of the national academies, and I got a loan, and they kept the loan, and I knew who they were, and they knew who I was. But of course, my last loan I got a couple years ago was sold 3 times in the last 2 years. I was hoping they were going to lose it, but they didn't. And I now have a relationship with Wells Fargo I never asked for, and I have never had one before. And you've all had similar experiences, I imagine. So here's how this works. You get a mortgage loan if you're a home buyer, and you make mortgage payments. So we got that. That's easy, right? Then, these days, the commercial bank or the mortgage lender sells the loan. We know that, right? And it gets money from selling the loan to Fannie Mae, Freddie Mac, or an investment bank. And what does it do with that money? Well, it then loans out more. So it gets more profits. That's a way to sort of accelerate higher velocity and create more profits. Well, so what do the investment banks, Fannie and Freddie, do? Where do they get the money to buy these things up? Well, they're creating asset-backed securities. Right? They're packaging these millions of loans or thousands of loans together into asset-backed securities that then can be bought and sold. And they keep a lot of them, and they sell off others. But they get the money to do this because they leverage their capital base. They borrow. They have a capital base, but they're borrowing more than their capital base from short-term investors. They're borrowing short and buying up long-term securities, in effect, which is a typical way banks work. So the short-term investors, and this is coming from that global savings glut that we talked about, and that's how the system works. During the boom cycle, early part of this decade, the system was great for housing. It just poured money into the housing market, right? We all know that. So the home buyers are making they're taking out loans, they're making their payments directly to some other party, like an investment bank, Fannie or Freddie, and the Fed has made really low short-term interest rates, so that commercial rates are in the 2 to 3% range for short-term money, but mortgages are paying 6 to 7 or more percent, depending on your credit rating. And so the banks are making money hand over fist, and in fact, they're making hand over about 10 fists because they're borrowing so much money. They're borrowing. Let's say that we have an imaginary investment bank that has $10 billion. It's going to borrow $300 billion in order to buy up loans. So this is great because they're magnifying their profits, just like everybody else. And all this money flowing into housing is making the prices go up and making people get bigger mortgages. And then the banks and everybody else starts running out of people to lend to. They started lending to people who they shouldn't have lent to, and people who shouldn't have borrowed started borrowing. And you know what that is, right? The subprime market, because they had so much money, and the interest rates were so low. However, something starts happening, and this is the vicious spiral. And a couple of things happen. The Fed, because the economy gets better, raises interest rates to 5.25, and Fed overnight funds rate, and that pushes up all short-term rates. And that's not a particularly high rate for an economy that's doing well. The problem is it puts the big squeeze on the investment banks because they're still getting only about 6 or 7% from these mortgages that they bought, but they're now borrowing at about 6%, high fives, low sixes, so they can't make any money. And so that's a problem. In addition, the subprime borrowers start running into trouble because the bloom is a little bit off the rose. Money isn't flowing into housing quite as much because of this squeeze on short-term borrowing. And so prices are tailing off. The subprime loans are starting to ratchet up in these arms to 6 or 7 or 8, 9%. We had a video at a recent meeting at TIAA-CREF where, was it Clarence? I think, Jody, was it Clarence? I forget his name, but they interviewed this guy. Sorry? It was Clarence. This guy, Baltimore, Detroit, I don't know where he's from, but he said, I got a subprime loan, and I wouldn't have lent to me, and all my friends said they wouldn't have lent to me, but I got a $500,000 loan. And of course, I can't pay it back. So this is what happens. And I mean, there's blame to go everywhere, but the point is that this is what starts the downward spiral. Remember our investment bank that had $10 billion to start and a $300 billion leverage on top of that? Well, let's assume that I have down here there's a 5% default rate. Well, today the default rate on mortgages is about 6% in the United States. And if our investment bank is only in the business of buying up mortgages and it's being hit equally, that means of that $300 billion, it's now lost $18 billion. Well, that's more than the $10 billion they started with, so they're officially kaput. And this is what happens to Lehman Brothers and Bear Stearns, and what would have happened to a bunch of other investment banks, and did happen to Fannie and Freddie, except the government took them over. So what are the critical effects here? I'll just run through this quickly. Because, I'll just put up the whole list, and then we'll do a few more details. So critical effects. Well, you get a bursting housing bubble. So we get that, because we just went through that a bit. You get a flight to liquidity and safety. This is, in English, buying treasury bonds instead of anything that has a credit or a corporate name attached to it, or private. Frozen credit, nobody wants to lend, and not that many people want to borrow either. You get the consumer pulling back. Remember you guys have started to save. That's great for you, bad for the economy at the moment. Disappearing jobs, so we know about that, and a big equity sell-off. So how do these things all connect, right? Because at the bottom there, you're starting to see the real economy effects. Right? Okay, so housing bubble burst. This one you get. We know that home prices are dropping, and they're continuing to drop. This is Schiller is Bob Schiller from Yale, the well-known economist who helped create this index. 20 major metropolitan areas are in here. Phoenix is the winner, or the loser, depending on how you want to couch it. It recently passed, on average, home prices are down 50%. And it passed up Florida. New home starts, down from a rate of 1.8 million starts per year to about 380. You see that little leveling off there. We're all hoping that that's a good sign. We don't know yet. The flight to safety, the Treasury yield curve. This is you'll know what this is, but it's the yields or interest rates on Treasuries, short-term on the left side, 3-month Treasury bills, and 30-year Treasury bonds on the right side, and it's just a snapshot at one moment in time. And what you see end of March 2006, 2007, at the top there's flat yield curves. There's flat to slightly negative. And that's the indicator that tells us about that squeeze that was on the banks. Remember, short-term borrowing was pretty expensive relative to long-term borrowing. They're basically they couldn't make any money by doing that short to long thing that banks do. Now, in the last couple of years, you see the curve is now steepened, so it's cheaper to borrow short, and the long-term borrowing is a little more expensive. However, the whole curve has come down so that effectively the shortest term interest rates are about 0.25% right now. If you have any inflation at all, that means you're paying Uncle Sam to take your money. And then on the long end, that's still some of the lowest interest rates we've had since the 1950s. It's a sign that everybody's flocking to treasuries. All they want to do is buy treasuries because it's the safest instrument, right? And they're shunning everything else. Similarly, LIBOR and the 3-month Treasury. This is a 3-month Treasury bill in the yellowish orange, and that's its yield. And then LIBOR is the blue line. LIBOR is the London Interbank Offering Rate, which is the basic short-term benchmark that banks use to lend to each other. So you'll hear, I got LIBOR plus 50, 50 basis points. The point here is you can see how close those curves are during much of this decade. They've gone up, both have gone up and down, but then they both come down. But you can see how close they were, and now they're spread apart, which is an indicator that people don't want private credit; they want government bonds. And similarly, here's some corporate bonds, and it's the yield spread, which is the yield on a corporate bond minus the yield on a comparable Treasury. And you can see the spreads just blow out in 2008 because people are driving down the prices and driving up the yields because nobody wants them. And these are, if I put AAA, which is the highest rated, it show the same, but this is AA bonds to BBB bonds, and then mortgage-backed securities and asset-backed securities. These are junk bonds. You say the same thing happens. Below investment-grade bonds, same thing. The yield spreads have blown out, and they've come back in both cases. They're coming in a little bit. That's a better sign. Credit isn't as frozen as it was, but they certainly haven't come back down to anything like historical averages. So fixed income market total returns, this just gives you an indication of some of this. I think this is helpful. In the first quarter of 2009, you see U.S. aggregate index includes both public and private fixed income instruments. So look at U.S. government. In 2008, that was the best returning asset class you probably could have found, right, if you invested at the beginning of 2008. On the other hand, the first quarter of 2009, you would have lost money being invested in these, at least on a mark-to-market basis. U.S. credit, which is the corporate bonds, you would have lost some in 2008 compared to gaining a lot in public securities. You were also down in the first quarter of 2009, but things are getting a little better in U.S. credit. Look also at municipal bonds, modest gains in 2008, pretty spectacular gains in the first quarter of 2009 because people are starting to, they thought Arnold Schwarzenegger was going out of business. And I know that things worked out badly yesterday in the election, but California can't go out of business. They can't go bankrupt. The Feds are pumping money into the states. So people are feeling more optimistic. Look at TIPS, inflation-linked bonds, down more than 2% in 2008, up more than 5% just in the first quarter. Well, people it's the one government security people didn't want because they were afraid of deflation, and TIPS don't do well in deflation, whereas nominal bonds do very well in deflation. TIPS do great in an inflationary time, and so people are now worried about inflation, so they're piling into U.S. TIPS. So that just gives you a sense of how bifurcated these markets were and how frozen the credit markets were. People just didn't want credit. Consumer pullback. This is just consumption as a percentage of U.S. GDP. In 1995, the consumer was about 60% of U.S. GDP, business and government being the other part. In 2005, it was up to 70%. In 2009, that's where we start to see some savings just in the last 6 months. What it's saying is the consumer is pulling back and saving more, but that means that they're not spending and stimulating the economy. And jobs are disappearing, and we all know about that. This is just the cumulative jobs lost since the 1st of January last year. The red is the incremental number for each month, and the full bar is the total. About 6 million jobs lost in the last since in 2008 through last month. Unemployment 9% and rising, so we get that. And now the equity market sell-off. That's the last point I made on that sort of summary slide a few minutes ago. The equity market sell-off. How did all this get into the equity markets? We can see how it gets into the real economy because it's beginning to it affects real jobs. If you can't get credit, for example, you can't fund your Christmas inventories or renovate McDonald's restaurants or do pretty much anything else. But how does this get into the equity markets when it's really a credit problem and a housing problem? Well, it's because equities were liquid. You remember our investment bank that got into trouble and was underwater? Well, one of the things it might have wanted to do, as well as hedge funds, because they levered up too. They borrowed a lot in order to invest. Well, one of the things they had all their loans called, their short-term loans, and so the lenders would say, well, we don't want to give you any more loans. Plus, we want, we're not going to roll over the loans you already have. We want you to pay them back. And so these institutions look, well, we got to, everything's frozen, except equities. So we better sell some equities. And everybody said it at the same time. And so we had a huge equity sell-off. So it was really the fallout from the credit markets that got us into the free fall in the equity markets. This is an indicator of volatility in the equity markets. It's come down a lot in the last bit, but you can see it was basically at all-time highs. And the long-term average since the index was started is about 18. And so you can see what's going on here. It's coming back, but certainly not to where it was. And then you see U.S. equity returns. We all know this is depressing, but I just want to make a couple of points. You see the 2008 numbers that are down in the 30s and 40s. But you also see in the first quarter the numbers for equities. If the market since March 6th has gone up over 30%. That's the largest rally since the Great Depression. The problem is that in the until March 6th, the market went down another 25% from the 1st of January, on top of what it did in 2008. So we've recovered from January, the period January 1 through March 1st, but we haven't recovered since the market started down from its peak. So it's a very volatile market, and you could see either good news or bad news depending on how you want to look at it. So what's next? This is just a sense of what have depressions, recessions, and bear markets looked like since World War II, and they don't always coincide. A recession being defined by the National Bureau of Economic Research. It's a committee of economists, academic economists. They're the ones who, last November, said, "Oh, by the way, we've reviewed the data, and we are in a recession, and we've been in one since the November previous, 2007." So you don't get forecasts from these guys, men and women. They look in retrospect. And then the bear markets are usually thought of as market goes down 20% or more. So that's and so here you see there's not a lot of pattern here. It turns out that we had a bear market and a recession that coincided, but that doesn't always happen. They don't always accompany each other. So it's not clear what's going to happen, and we're not even clear that we're out of the bear market yet. I mean, I think we've had a big upturn, but is it really going to surge until we get up to 14,000, which is what the Dow was when this problem started? Don't know, and we don't know whether we're out of the recession, or I don't think so, because I think this quarter is going to come in negative territory again. Last quarter came in on an annual basis of minus 6.1% GDP. I think this one's going to be much better, but it's still going to be negative. So we may get better in the latter half of the year. In fact, I think we will. If we're going to be down 3% for the year, then we're going to have to get better in the latter half of the year. So this just summarizes things. The global outlook, if you take a look, our forecast is world GDP goes up about not at all. Now, in the United States, a kind of potential economic growth is about 3%, long-term potential economic growth, and we bounce around up and down above that and below that. And so we're way under our potential growth. In the world, potential growth is much higher than that, because most economies are developing economies have much higher potential. So to avoid a recession, we generally need to grow in positive territory. To avoid a recession because of population growth and other factors in the world GDP needs to grow at least 3%. And it's not going to do it. This is the first worldwide recession. If it turns out that I'm unfortunately right, this will be the first worldwide recession since World War II, because there's always been some part of the world that's done better to pull things up. And this is leading indicators for developed countries, still headed down. Just a basket of indicators having to do with consumer confidence, interest rate spreads, share prices, manufacturing orders, that sort of thing. It's still headed down, but we hope we'll see a turn up. That U.S. balance of payments. Now this is sort of good news, but the point I want to make here is simply that there's been a race to the bottom. We're importing less stuff, and therefore we're paying less, less money overseas. But the problem is other countries are also importing less stuff from us, so we're kind of seeing who can race to the bottom fast enough. So in a way, it's good news. And what we'd like to see, though, is this number happening during good times, not bad times. And similarly, this is the trade balance. Well, it's just reversed. It's negative. This is a negative scale. So it's the same kind of stuff. So what's the emergency medicine? Well, again, the New Deal comes up here, or the Great Depression kind of comes to mind, because I think there's a lot of similarities, not in terms of how bad it is, but in terms of the spirit of what we're trying to do. And the main spirit of it is experimentation. In the nobody knew what to do. Keynes once went to visit Roosevelt during the Great Depression, and he hadn't published his book yet, the General Theory, and Roosevelt listened to him, but Roosevelt had never had an economics class in his life, and sort of scratched his head, and Keynes went away. And so whatever they did in the Great Depression, it wasn't because of any theory about fiscal stimulus or consumption that's contained in the general theory. And in fact, they tried to balance it. In 1937, they tried to balance the budget again. And the Fed thought there was too much money, so they jacked up interest rates and pulled back on the money supply. And then in 1938, we went right back into the Depression. So it was that magic stimulus of World War II combined with consumer saving, because there was nothing to spend on in World War II, that really did it. So, but you saw bank rescues and stress tests during the Great Depression. You had consumption stimulus. Maybe you can argue about how big that was. Infrastructure spending, the Public Works Administration and the Works Progress Administration, WPA and PWA, job creation, Civilian Conservation Corps, et cetera, et cetera. Financial system reform. The Fed gets strong. A lot of other things happen. So we got $790 billion in stimulus package. That's spending authority. Now, the spending authority, just be careful about this, because you see the 24% in this year. Well, that's spending authority. But we all know that governments have a hard time spending stuff. Once they get rolling, they can do it. They can build that aircraft carrier. But it takes them a while to get rolling. And so we're not going to see 24% of the money actually go out the door in 2009. Similarly, it's just going to get pushed back generally. In housing, I'll talk a little bit more later about specific points in housing, but help for homeowners and underwater mortgagees. Financial system, we have all the T's, the TARP, the TALF, stress tests, public-private investment funds. I'll talk a bit more about that in a minute. And then you have the talk about long-term regulatory reform, but there hasn't been anything really specific yet. All right, the composition of the stimulus package, just suffice it to say that it's great for higher education and research. We all know that, because every research and institution and higher education institution in the country has already got their proposals in. Or if they don't, they didn't hear the news. And everywhere I've been, oh yeah, we already have our proposals in, we're ready to go. And what one hopes, this is the upper part of this slide, is the part where it really refers to Rahm Emanuel, the chief of staff, saying, don't ever let a good crisis go to waste. This administration believes in that research and education are the way you invest for the future. You don't just buy machine tools. This is the way you invest for the future. And I think they're hoping to have a permanent increase in spending. Certainly, I like that. The aid to state and local governments is the one thing that's really going out there fast. It's not just for Medicaid, but it's really going to help state and local governments. So Arnold will get some help, not as much as he wants. And then tax relief, money going into the pockets of individuals, that's going to happen pretty fast. But the worry is that people are going to save it, like they did the Bush. They saved like 83% of the Bush tax cut last year. Okay, assessing the stimulus. It's a big, diversified, somewhat sustained. See, it goes for several years. And in fact, that's probably the best thing you can say about it. We don't know how big it should be, but we know it's big. We don't know how diversified it should be, but we know it's diversified. And we don't know how sustained it should be, but we know it's somewhat sustained. This is the experimentation part. So, okay, that's maybe good, but we don't know how good. Other considerations, well, Larry Summers has been arguing, we got to do this because the risks of overspending are much less than the risks of underspending. And that's all he can say. That's not very precise either, right? And we all know that the economy was getting worse anyway, when this started. And the rest of the world is in recession. So it's a mess, but maybe it's the best mess we could have at the moment. The housing package, homeowners, they're trying to help people who, in various ways, people who have loans between 80% and 105% of current house value can refinance. Okay, homeowners who are behind or struggling on payments or are underwater are eligible for monthly payment reductions. And there's additional incentive payments to encourage borrowers and lenders to avoid foreclosure. Some changes in guidelines, and so forth and so on. Well, so is that going to do much? Well, it doesn't help people who are underwater get above water. It just helps them sort of float along. And conditions are likely to get worse. We're going to see continuing house price decreases, and it will be spotty. it's absolutely not going to be across the board in the United States geographically. Unemployment is rising, and then there's some negative amortization loans that are going to be reset in 2009. So, we don't know if it's going to be enough, and it's hard to find individual homeowners to help them. So we don't know. And of course, there's also some moral hazards and stuff here. People are making out who the worse you are, maybe the better you're going to make out. Same thing with the banks. The financial stability plan. Yes, we're having stress tests for the banks. There was a very careful political rollout of those stress tests. A lot of banks had to raise money, but they were still deemed to be in much better shape than we thought they might be. So that was good. And the stability plan also has calls for regulation, like oversight of these credit default swaps that a lot of which were unregulated. And then finally the TALF and the TARP and so forth. The TALF, the Term Asset Backed Securities Loan Fund, is an effort to get to, is the federal government's effort to get new consumer loans, autos, credit cards, et cetera, small businesses for institutions to make those loans, and then the federal government is going to help institutions buy them up, to keep the money flowing into those sectors. That's new loans. The TARP is for the old securities that are, the bad securities that are on the books of the banks. So the TARP is the Troubled Asset Relief Program. And in fact, what the federal government did is instead of buying up those securities, they went in and bought the banks, in effect, with preferred stocks, acts like bonds, but a bit. And at any rate, they and the auto industry, use it to buy into the auto industry. They have about $100 billion left in the TARP. And then this PPIP is to encourage the purchase of securities, the bad securities. Since the TARP wasn't doing it, they changed the TARP. This PPIP is to encourage the purchases of bad securities. And the feds are going to subsidize that sort of 6-to-1. They'll put in $6, and BlackRock or whoever will put in $1. TIAA-CREF, by the way, is participating in the TALF in a small way, but we think there's some good opportunities there in new credit instruments that are being created. So what's good? How do we assess this? Well, it's a good deal for the banks and the investors, of course, because then the banks don't go under, and then they get substantial loans, and their assets are the collateral. So so it helps them from going under. And then if they want to pay some of this back, like the TARP money, they can do that even if they're not loaning to anybody else, which is what's going on right now. Why are all these banks saying, "Oh yeah, we want to pay the money back right now"? Well, it's because they're not loaning out the money; they're sitting on it, and so that's not making things much better. So, as I said, there's about $100 billion in TARP money left, and that's why they're trying to leverage that, because they don't have that much money left. So they're trying to have these public-private partnerships, et cetera. And the question is it going to work? Well, we don't know. We don't know whether the banks, after they pay back the money, are going to be in good shape, but they're desperate to do so. We don't know what the toxic assets are going to be priced at, and with the feds involved, we're not going to have a real market clearing price. We'll have a subsidized price, so we don't know. And the other implication is the government now has a huge influence over credit that it didn't have. All right, so what happens if this begins to work, at least in the short run? The signals are going to be, here's some signals. Banking sector write-downs diminish. We're already seeing that. They're not writing down as much. AIG hasn't come back to the government in a few weeks anyway. And housing stabilizes. Well, you see mortgage rates solidly sub 5%. Well, they are now. And the federal government is really committed to keeping them that way. And inventories have declined. Lending begins to resume. Well, the image I'd use is it's a glacier. Credit has frozen, but global warming has taken effect and it's melting around the edges. And so hopefully it'll keep going, unlike global warming. And credit spreads have narrowed, but not in a dramatic way. Income stabilization. People have been losing income. In real terms, incomes have gone down since the year 2000. And it shouldn't be going down. They shouldn't be going down in good times, but they're going into this recession having gone down. The only group cut by education levels that had an income increase between 2000 and 2007? Can anybody guess by education? MBAs, JDs, and MDs. PhDs were actually above water until 2007, and then they dropped. So consumer confidence, it has increased. It dropped dramatically, but consumer confidence in the last couple of months has increased. You get declining deflationary pressures. In other words, prices, the stuff's, businesses stopped having fire sales, or have fewer fire sales, and hopefully wages wages stop decreasing as much, and you get some more investment. Well, that's in the short run, but what happens in the long run? If we get, there may be some good news. I'm saying there are probably some bits of light. We see the markets have gone up. The economy could begin to improve in the second half, so forth and so on. So, and stimulus package could begin to work. We're all hopeful about that. But what about the longer run? I won't read this, but this is Alan Meltzer at Carnegie Mellon. This was you may have seen it. A week ago Monday, there's only two people on the opinion page, Alan Meltzer and Paul Krugman. They didn't let Maureen Dowd on that day. And Meltzer's basically saying in this quote, inflation is coming, guys, because the Fed will not be able to resist the pressure to keep interest rates low when the economy begins to improve, and that will bring on massive inflation. On the other hand, Krugman, on the same page, says, forget about inflation. We need more stimulus, more decisive action on banks, more job creation, and the risk, if we don't, is that we'll turn into Japan with years of deflation and stagnation. So you couldn't get a more diametrically opposed set of views. One of them has a Nobel Prize, the other one doesn't, but I don't think, that's not how we're going to decide this argument. And so the question is, are we out of the frying pan if things recover into the fire? Do we need more stimulus? Well, it's going to be politically, it's going to be very hard to wean ourselves off of stimulus, right? Everybody's going to want to keep that spending going, so that's going to be eventually inflationary. We know that. On the economic side, are we going to repeat problems that got us into this mess? I mean, the federal government is now leveraging, even if ordinary individuals and businesses and banks aren't. They're going into the leverage business in a huge way. And that was one of the problems that got us into this mess. And will we make the right choices about restructuring the financial system to get to change our oversight so that it matches better the financial system? We don't know. So that's a question that I think is going to be really important, because there's not going to be inflation soon. I mean, I'm going to side with Krugman in the short run, but I'm going to side with Meltzer in the longer run. Because if we don't fix some of those long-term problems, we're going to get inflation and we're going to get a lot of other problems. So I'm almost done. What's an investor to do? What is in all of this? Well, I'm going to contrast some old rules for investing and new rules for investing, and it's a straw man, and I'm being cute, so don't take it too seriously. At least the old and new. Take the rules seriously. The goal is to build wealth, right? That's an old rule. You want to build wealth. That's the only thing that's going to get you there. You want a pot of money that it's yours. Okay, well, that sounds good, doesn't it? But I'll explain why. I think it's an old rule. You're your own best investment manager, right? Right? Everybody says, oh yeah, you can do it. You know how much to save. You know what funds to pick. You know when to reallocate, right? You know all that stuff. Think about the person on the assembly line. Returns are the key to long-term financial security. Absolutely. That you want to get the maximum returns you can, because that's going to assure your financial future. Maximize your investment choices. More. I want 500 funds to pick from. And they'll offer it to you. 5-star performance is what you need. You want to find that 5-star fund and stick with it. Equities are king. We all know that that's where the returns are going to come from. The equity risk premium is going to be there for us. Go with the brand name. They're the ones that everybody knows about. Don't let them take your money away. It's wealth. It's your wealth. Don't let anybody touch it. Well, I guess that's the last one. So those are the old rules. 401k model, by the way. New rules for rebuilding your retirement portfolio. Okay. So actually, these are the old rules. I mean, the old rules. So let's watch this. Rely on a trusted advisor. Nobody's an expert, oops, including me. I don't spend all my money, all my time managing my own portfolio. I think about asset allocation all the time and model it, but I'm not thinking about my portfolio all the time. So a trusted advisor, somebody who can really sit down with you and not necessarily tell you what to do, but to ask you questions about what's your risk tolerance, what are your goals, how have things changed, what are some scenarios that we could create that can help you choose. The goal is income, not necessarily wealth. Wealth is great, but before you get to wealth, what you want to create is a future income stream for yourself. You want a smooth consumption over your lifetime. That's economic talk. And the goal is to set yourself up so you have income. The problem is if you think of it all in wealth, then it's going to be very hard for you to create a solid income. And for example, having a guaranteed income so you won't run out, right? Because to do that, you have to maybe buy an annuity. And if you do that, maybe you're not going to have as much wealth, or you're not going to think like you have as much wealth. And so the 401k model says forget about that guaranteed stuff, that income. You just want wealth. And that's taking a big risk. Savings, not return. Now, returns are great. But it turns out savings is the first thing you need to do. And it also, it turns out we've done the research. Before you get to returns and asset allocation, the things that determine how much money you have in relation to your salary are how long you've been in a retirement system and the contribution rate. So it's not that the investment stuff isn't important, it's just that it comes after. The market could be different in the future. It's possible the equity risk premium is going to be lower than it has been. Maybe it won't, but it's possible that there's going to be some longer-term effects of this downturn. So you may want to think about the market, and that equities may not be king in that circumstance. Understand your own risk tolerance. Think about that before you start thinking about massive fund choices. And then these three go together. Diversify. Diversify into asset classes. Don't think about 500 fund choices, but think about a small number of asset classes that can help you diversify. And asset allocation, aside from savings, is also the key to long-term return. Rebalance and reallocate. Do that carefully and systematically over time. Stay the course. It's really easy to read the paper every day at a time like this, when the markets are going way up or way down, and say, okay, I've got to do something. Now, the joke I had before was, if you guys know what to do, where to put your money and when to take it out of the market and stick it in the mattress, I want to buy stock in a mattress company. The problem is it doesn't work anymore because 1-800-mattress declared bankruptcy. So, and the second to last thing is simplify. This is not that complicated. If you're not focused on chasing returns and making 500 fund choices and so forth. And the other thing about simplification, we said this, didn't we? But that's how you help simplify. Get somebody to help you think through it in a systematic way. And it isn't just savings, it's also taking income and balancing off your income needs with your bequest needs, wealth needs, et cetera. Those are the things. In other words, have a long-term view, because it's too easy. There's too many people who have shoved the money in the mattress and then missed out on 30% stock returns in the last 2 months. Too many people who may have had an over-allocation to equities because that's what they were told, or those were the funds they were presented with. It's the old tried and true. Sorry to end on such the long-term note rather than having the magic bullet, but that's really where I do want to end. I hope I've given you some elucidation about what's going on and why, and what we think may be happening down the road. I can talk a little bit more about what I think markets are going to do in question period. But let's switch to a question period, because I think that's important. I'm glad to answer your questions. Yeah.
So what are markets going to do?
Well, the stock market has gone up a lot. The problem is that the way the simple way to think about stock markets is the ratio between price and earnings, right? PE ratios. I mean, there's lots of other ways, but that's one simple way to think about it. We've had a lot of increase in P, but we've had no increase in E. In fact, E is still declining on a global basis. So we've had a big jump in PE. And that scares me. It doesn't mean I know that markets are going to go down. It doesn't mean I know what they're going to do. But I don't see the foundation. The foundation for a long stock market rally is when E is potentially going up. And that isn't going to happen for another several quarters, I don't think, at least not in any big way. On the other hand, municipals got beat down last year. Corporate credit got beat, corporate bonds, tips, they all went up this quarter a bit, but corporate bonds didn't, but they didn't do so badly. I think that there's some opportunities in asset classes like those. Although I've just got through saying that you should have a long-term view and not try to time the market, but it means that it's not a terrible thing to think about a broad portfolio that can take advantage of those things at a time like this. And I don't think real estate is ready yet. It will be. Commercial real estate, like we offer, doesn't buy residential, single-family homes or condos, but commercial real estate is in a natural, cycle, and it's in its down cycle. It hasn't had one since early '90s, so it's not ready yet. But I think that's where things are going. There will be a run-up in the stock market, more than what we've just seen, but I think you need to have on the horizon a better economic outlook and a better earnings outlook before it'll be sustained. Yeah. Well, that's already happening. Commercial real estate is going through its cycle. Their credit is harder to come by. Donald Trump is running around looking for credit right now, but TIAA-CREF does not invest in Donald Trump properties. It's never done so. No, and just to finish the serious point, that is happening. We don't expect it to be as deep. Retail malls are not in great shape, and we do invest in retail malls. But the difference, the last big meltdown was end of '80s, early '90s, and it was pretty severe. The difference this time, there's two differences. One is credit is a little harder to come by now in commercial, but not as bad as residential. But the good point is that we didn't overbuild. In the late '80s, way overbuilt. Did not do that going into this down cycle. I'm not saying it's all rosy, but it's much better. And so we're much more optimistic than, let's say, the last time. Yeah. Oh. Can it work? Well, I gave you some pros and cons and so forth. Nobody knows because it's an experiment, right? One way to think about it, I would suggest, is we've created. You can quibble about the numbers, but we've created roughly a $3 trillion hole in our economy. Our economy is about $14 trillion. And by that I mean, if you look at potential GDP, modest 3% growth rate, and where we're actually going, it's about $3 trillion gap. The stimulus package and sort of everything else could make up, if you the multiplier effects and so forth, maybe $1.5 trillion of that. So that's good, but we're not going to get better. I mean, you have to define. What I'm really saying is, what do we define by work? Are we going to have minus 6% GDP? No, it'll help it. Main thing it's going to do, and the TARP and the TALF and everything else, is prevent it from getting worse. It's not going to get us back to 3% growth again, and I think that's fair to say. Other than that, that's a pretty wide, range, and other than that, we don't know because it's never been tried. Nothing's been tried on this scale. Well, I think that we're going to need more, and it's going to, and that's going to be bad because we'll get even more addicted to deficit spending. You're being patient. TALF, yeah. Oh, we would do that in our general account, which supports the TI traditional annuity. We do it there because we can we can buy illiquid securities, which these things could be, what we care about there is how much yield is it throwing off. We don't care whether the market price goes up and down so much. Well, what we care about is the yield. And so we analyze things in the general account according to what interest or yield is they throwing off, and what are the chances it's going to default and stop paying that. So that's different from a bond account where you care whether the prices go up and down every day. So we're doing it there. It's modest. It's not, it's a very diversified, our TIAA trade is very diversified. So it's not, so we're not taking a huge amount of risk. And we're not buying the riskiest tranche that's paying 16%. We're going to buy a tranche that pays 8%, but that has the highest quality instruments in it. And 8% is great in the current environment. Yeah. The counterfactual is it's very important to think about. I think that there are people who are saying that we should do something like that. And Meltzer, I don't know how far he'd go, but he's more in that camp. And my own view is that what prevented this, we had minus 6% growth in the last quarter of 2008, another minus 6 this quarter. It'll get revised, but it's roughly that. What's going to prevent it from being minus 6 this quarter that we're in and next quarter, I think, is the actions that have been taken, A, to stabilize the banks as much as they can, and B, to start spending money. And the Fed also jacking up the money supply and lowering interest rates. All of that stuff, I think, helped it from getting worse. And if we were then to take the step of saying, okay, we've done enough, we're going to balance the budget, and we'll raise interest rates, I think it would be similar to what happened in the Great Depression. We go right into a tailspin. Are we doing? Is the Obama policy and Bernanke policy the best that we could think of or do? I don't know, but it is less worse than the alternative. Yeah. Other questions? Yeah. Yeah. Well, of course, in the short run, they're going to lower them. They already did lower them, so that's good. But feel good for a while because it ain't going to stay. If you look at the long-term macro picture, Brookings has some models that go out 75 years to try and match the Social Security and Medicaid analyses that the federal government do, and that's all. That's one little change in the assumptions, and you get huge outcome changes. But nevertheless, it is extremely hard to imagine that we can't have significant tax increases. And so the question is, where? Can you, and if you're Obama, you're saying, well, maybe we can get it out of the top 5% of earners in the United States. We need, what's our estimate about? We need about 5.7% of GDP in new taxes, new revenues, over a long period of time to take care of Medicare, the economic stimulus that we're going to be doing for the next few years. That's a lot of GDP. Considering that government as a percent of GDP is going from 20 to 25 as we speak, 5.7 is a lot. So it ain't going to come from the top 5% of earners. You just can't. So is it going to come from the income taxes on the rest of us? Is it going to come from payroll taxes, raising Social Security and Medicare taxes? Well, there's a couple of alternatives. One is that some people have been floating is to create a VAT, like a European VAT. And in my mind, the scale of the numbers is so big, I can't imagine how we could avoid it, even though we never talk about it and it's really taboo in Congress. So it's the best I can think of. Yeah, did you have a?
I was just going to ask you, what do you view as munis as an asset, particularly California?
Well, you got Corzine and you got Schwarzenegger. What could be bad? I think that I actually like munis. I mean, local cities can go bankrupt. States actually can't. They're not allowed to. As I say, they've been beat up as though people shunned them as though there was going to be a lot of bankruptcies. But there's a lot of money flowing from the federal government. It's called Medicaid money, but it's really not. in other words, they can substitute. Oh yeah, we're going to use this for Medicare, Medicaid, but then that frees up